In this video, I'm going to examine a Barclays option trading strategy that they say is guaranteed to capitalize on retail option trading volume. Essentially, this research report shows you how to rob the Robinhood investors and pocket the money that they're spending on out-of-the-money options. Boy, do we have an interesting one today because it's exactly what I've been teaching and using as my strategy for a number of years, but it gets even better. After I go over the report, I'm going to place 10 small trades for the week to see how much money we can make off of these ideas. This is going to be episode 1 of Trading a Small Portfolio to Millions Challenge, and the objective here is to see how much return we can make per week so we can grow that juicy portfolio together. Despite me having a large portfolio, I'm only going to place micro trades today and use a total of $5,000 or 5 bands. Before I jump in and flood your pockets with money, make sure that you like that smash button for Uncle Henry, and also just subscribe to the dopest YouTube channel because it's scientifically proven to make you stupid rich. I'm going to start off by explaining the Barclays research article, followed by which strategy I plan to use to capitalize, and finally I'll place 10 trades for this part of the series. This is a 30-page research report from the Barclays derivative team about the strategy they developed to capitalize on new retail option trading volume, literally a specific blueprint of how to make money from the degenerates of Wall Street bets. At the end, they used 2 different trading strategies to drastically outperform the index. So I thought it would not only be funny to examine how Barclays takes money from traders, but also interesting for me to apply my option strategies and theirs to see how it performs with real dollars to see if you should do it too. They say, we show that retail investors have been driving a significant increase in option, mostly short-dated calls, volume for large cap tech stocks. We use several unique data sets and detailed analysis to show that this activity has had a material impact on option prices and is large enough to potentially affect the underlying stock prices. They also mention implied volatility for shorter dated calls that has increased relative to puts and longer dated options. I'm going to save you the time from reading the rest because there's so many pages of unnecessary and probably boring amounts of detail unless you're a numbers nerd like me. So I'm going to summarize the most important parts instead. If you want to read the whole thing, then I'll put the link in the description below. So basically the first 5 charts show you how much volume has increased. And I guess that's not surprising, especially figure 5, which shows you the put call ratio, or basically to sum it up, everyone has been buying call options going YOLO with their stimulus checks. And in a brilliant, remarkable act of randomness, all the options were bought on large cap tech stocks. I'm sure that was a coincidence. So we all know that this was driven by retail activity, and if you're not convinced, then look at figure 12, which shows you the surge in small order size call option volumes, which indicates higher retail participation. Unless the billion-dollar hedge funds decided that they want to click buttons all day and start trading a couple $100 a trade on their billions of dollars, this is definitely retail trading activity. So how does all of this come together, and what opportunity does it create for my subscribers and I guess the rest of the people who are watching my videos? Well, that's where I'll skip to page 19, where it literally says monetizing retail-driven option volatility dislocation. This report is technical, but to break it down into layman's terms, the first way to monetize is by essentially selling straddles to capitalize on short-term volatility. They're basically saying that selling or going short on volatility on certain stocks is a good idea. Specific option strategies I will discuss and show you shortly allows you to go long or short volatility. Now you don't need to accurately predict which way a stock goes, only if a stock will rise a lot or a little in one direction. If you watched my Iron Condor video, I'll link below, or not, this is the perfect strategy to use because Barclays is recommending to sell straddles. However, straddles expose you to unlimited risk because it involves selling a put and a call simultaneously. That's why I'm going to recommend selling Iron Condors, and will do so because this strategy does not involve unlimited risk. In fact, it involves very little capital and high returns. Iron Condors still capitalize on the fact that you're selling options and making money when a stock doesn't move as much as its implied volatility. So here is a quick primer on Iron Condors you need to know about before I show you what I'm going to do to abuse this information. The Iron Condor puts probability, option time premium selling, and implied volatility on the trader side. The Iron Condor option strategy is one of the best ways for an option trader to profit from an insignificant move in an underlying asset, or when implied volatility is too high, which is what Barclays is saying is going on in the market. So while all the retail traders are buying call options short term to speculate on a big move, you bet the complete opposite and make money off of their bets. Many traders believe that a significant move upward or downward is needed for them to make a profit, but that's simply not true because iron condors make money in sideways and in volatile markets so long as the stock doesn't run up a huge amount, say 20% in a single week. But luckily that's usually not happening. So 8 and even 9 out of 10 times you're going to sell an iron condor and be successful. But even when the worst comes to worst and you get executed, your winners will far outweigh your losers. So you will still end up with long-term profits. Let me share my screen with you guys and show you 10 trades that I'm going to make using this strategy. Here is a chart of the stocks which have benefited from the highest increase in option trading over the last year. And in episode 2, I'm going to pick 10 more to run a different spread strategy. Let's jump in and see how much percent returns we can make in a single week trading iron condors with this specific strategy. All right, guys, so here's a list of the 20 stocks that I'm going to be trading. And the first on the list is Tesla. I'm not going to do all 20 stocks because I'm only going to do 10 today. And specifically, I'm only doing iron condors today. But the good news is, actually, we're going to use less capital on these 10 trades than $5,000. So it's going to be a very good trading day for us. And the market just opened. It's about 8:32 a.m. here in Medellin, Colombia, my actual last day before I go to Ukraine. So let's crush it and see how much money we're gonna make. Going into Robinhood, I'm first going to go into, so let's see. Tesla is on the list, Amazon, Apple, Microsoft, Shopify, Nvidia, Alibaba, Google, AMD, Netflix, Facebook, Walmart, Zoom, Boeing, Roku, mRNA. I don't follow this stock, but I know that they are in Bitcoin processing like Riot. Another Google, PayPal, JP Morgan, and Square. I'm trying to think which option I will trade first. We can just go ahead and do Tesla. Tesla is up this morning. I already looked. And Tesla is at 706. And I have a huge position on Tesla already. So this is going to be an interesting option to trade. So I'm going to go for August 13, which is this Friday's expiration. And I'm going to go very, very far to the money. And I'm also going to use Yahoo Finance to figure out what strikes I want to sell. So I'm going to be using Bollinger Bands to find good strikes to sell these iron condors on. For Tesla, the bottom of the Bollinger Band is 619. I'm going to change, oh wow, it's already 2 standard deviations. So Tesla actually has a lot of room to fall and not a whole lot of room to rise. So I'm going to be biased against selling the call spread side of things. So let's first open up the puts, and I'm going to go very, very, very far down to 620 looks good, and 615 looks okay. So we're going to sell this. We're going to buy that. And so far we are making $8 on 500 bucks, but now we have to sell the call spreads because put spreads plus call spreads equals iron condor. So we're gonna go ahead and sell, and the top of the Bollinger Band is 724. Just to be safe, I'm going to go a bit higher, and there's a lot of premium to be made on the calls. Wow, my goodness. We're gonna go for 770 and 775. There we go. So now we have $22 and we make profit as long as Tesla does not go below 619.77 and as high as 770, basically 770.23, okay? So basically as long as Tesla stays within this range, then this iron condor is going to be profitable, and $22 might, or $23 might not seem like a lot of money, but we're only going to be risking, well, actually less than $500. So this is a $500 trade, but because we're collecting $23, we're actually only risking $477. So this is going to be nearly 5% on our money in a single week, which is insanely high, right? That's a very high return. So the first thing we're gonna do is we're gonna sell that. I'm gonna put 0.22 because I really wanna get executed and not waste time and keep moving with the video. So $22, collateral 500, submit. I think I have to collect less than $22. So we're gonna go ahead and replace that order. We're gonna go ahead and do again 1. Oops, it says 11, 1. And I'm just gonna go for 20 bucks because I don't wanna go back and forth and play around for a couple bucks. But If you want to, you can always put in 21 or whatever price you want to get, you can always put that in. It just may take some more time. But here we go. I got executed at $20 and the risk is $480. So that's a little bit over 4% return in a single week. So far we're at 4%, or about 4%. I'm actually going to add up the entire total at the end and show you guys. So the next thing that we're going to do is I'm going to skip down to Apple. And the reason I'm going to do that is because, well, Amazon is a really large stock. The price per share is very high. And I know sometimes the spread isn't $500, sometimes it's $1,000. And I promised you guys that I'm going to make trades that are going to be less than $5,000 total for all 10 trades. So we're gonna skip down to Apple and I'm going to click back to Robinhood. Click Apple, and now again we're going to use our Bollinger Band to see at what point we should sell Apple. See where Apple is in terms of its charting cycle. Here we go. So Apple is at the middle of its Bollinger Band range, which is really good for iron condors because it makes even more sense to sell calls and puts if the stock continues to go sideways. So let's go to Apple and let's go to trade Apple options. And again, as always, I'm going to start off by selling the put spreads. I'm just more used to the put side of things, but you can also start off with selling calls. The call spreads, it doesn't really matter. So selling put spreads, I'm going to go down, and this is actually going to be a $100 trade. So this is actually even better for you guys. So I'm going to sell the 140, buy the 139. That's already a 4% return, so we're going to make a lot of money here. I'm going to go to sell calls, and now I'm going to sell, and that's where things get a little tricky. As you guys can see, the spreads are $250 wide. So the only thing I can really do is sell the 149. I can't go higher than 150. So I'm going to sell the 149 and I'm going to buy the 150. And we have $16 and we're only going to risk $86 because this is a $100 trade. As you guys can see, we're going to make $17 and risk 83, which is an over 17% return in a week. So that's huge, okay? That's gonna really bump up our average here. So that is massive, 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 massive. So continue. One, and we'll go for 0.16. We actually will likely get 0.17 here. We can get 0.17, but again, I don't wanna waste any time over $1. And actually it looks like the Apple traders have gotten a little bit greedy, so they don't wanna take $16. So I'm going to have to go for $15. A little bit of a pain in the butt, and I actually might get executed for 16, but we'll see what happens. Submit. So one of the downsides of trading iron condors is that because you're dealing with 4 different options, on put spreads you have 2 puts, and on call spreads you have 2 calls. Sometimes you may not get executed even if you bid at the bid. So here, I did not get filled. I still am at 0 out of 1, and even $15 is not getting filled. So I'm going to have to go down even lower to $14. And that is most likely because of the bid-ask spread. As you guys can see, I'm actually losing some money on the bid-ask spread. It's not a whole lot, but there we go. So we got $14, so that's 14%. I wanted $17 or $16, but 14 is fine too. That is a huge, huge return in a single week. So over 14% return on this trade. And I will put up on the screen, as always, how much percent return it actually is. The next stock we're going to trade is Microsoft. This is the 3rd trade that we're going to make. So MSFT, Microsoft, and let's go to the charting as well. And the reason I want to do that is because I always want to make sure that when I'm selling iron condors that I'm being very safe with these transactions. So Microsoft is more near the top of its range, so I'm going to be more comfortable selling call spreads again a little bit more aggressively rather than the put spreads. However, again, we're going to have a very good iron condor. It's going to be between 292 and about 280, okay? Go to trade Microsoft options, and we're going to go to sell puts again. This is going to be like clockwork for us. It's going to be very fast and easy. So this is actually going to be a $250 trade rather than a $500 trade. So actually we might need less than $4,000 today by the looks of how things are going so far. So I'm going to sell the 280, and I think 280 looks very good to me. So 280, and we're going to buy the 277.5. That's $9 or about $10 in terms of premium. Now we're going to go to sell call, and we are going to sell, let's see, the top of the Bollinger Band is 292. So I'm going to sell about 295. And again, I want to be more short and I'm going more aggressive on the call side of things because there's a bias towards a lot of people buying call options to be more specific rather than puts, but also, just in general, straddles, as we discussed earlier, are going to do well, but I'm more comfortable selling call options because I'm trying to be more aggressive on the upside since Microsoft is closer to the top of its Bollinger Band. So selling 295, and now I'm going to buy the 297.5. There we go. We got $33 for just under $250 worth of risk. So this is an over 10% return right here. As you guys can see, $33 for $217 worth of risk. So that's going to be a huge return. I'm going to put on the screen as usual, but I know it's going to be about 11, maybe 11.5%. So I'm going to open up one contract here and I'm going to put actually 0.29. Let's go with 0.29. And that's going to be closer to the 10% range. And we got filled. Time for our fourth trade. It's going to be on Shopify. Now this one is a stock that I really love selling iron condors on. And I actually probably already have a position open on it. And if I don't, I had a position on it last week. So Shopify, we're just gonna take a look at the chart right here. I'm not even gonna use Yahoo Finance because I'm very familiar with the stock. And I know that it's been trading sideways, which again is very good for selling iron condors, because if Shopify continues to trade sideways, then we're just gonna be collecting a whole bunch of premium. So at the top of the range, maybe 1600, and at the bottom, right around 1450. So let's see if we can make that profitable in terms of trading. So sell, put. This is the fourth trade that we're making. So let's go down to about 1450. And I can even go a little bit safer. I can go 1440, 1435. So sell that. And we're going to buy the 1435. So that's $35. That's about 7% return. And now I'm going to go to sell call. And for selling calls, I think we said around 1600. So I'm going to go up to around 1600. And the premium is very good. So I'm going to go up just a tad higher to 1605. I'm actually going to open up and take a look at the volume. Volume is low. Let's take a look at here. The volume is low. So we're just gonna have to deal with low volume. You're not always going to get the most optimal trades in the world in terms of selling iron condors, because you just have to deal with so many different legs of the option. So we have 4 different positions, as you guys can see. So even if you don't get the most perfect prices, that's still fine because you still collect so much money in terms of premium. Let's click continue. And unfortunately the bid is 0 and the ask is $5. So I'm just gonna be honest with you guys. This is not going to be the most easy iron condor to trade. However, I still believe we can get some money for this. So let me put 0.9. And if I don't get a good return, then that's fine. I'm just not going to do it. So this is going to be a credit. You always want to put credit because that means you're collecting income. And this is going to be, oh, we got filled. So $100, if you collected $100, that would be 20%. So this is about an 18% return. So it's actually a little bit higher than 18%. Massive, massive premium on Shopify, guys. All right, the fifth stock I'm going to be trading is Nvidia. Nvidia has a lot of good options, I know that. And the premium is going to also be high, just like Shopify. And I'm also very familiar with this stock. I do have contracts here, and I am up some money already on the contracts that I have on Nvidia. So I've already been successfully trading Nvidia 6 times in a row for the private option income academy. So let's go to trade Nvidia options, and I already have an idea of what I'm going to do. So the stock is at $203. We're going to go down, and let me actually pull up the chart real fast. All right, so Nvidia is also at the top of its Bollinger Band range, and it's also above its moving average. So this stock, I am biased, again, similar to Microsoft, to selling call credit spreads. So we're going to be more aggressive on that side of the equation, and we're going to be more safe on selling puts. So for selling puts, I'm going to go down to 187. That seems very safe to me. And then 185. And I naturally have an instinct here that these options probably have a delta of like between 8 to 15. And it's even lower than that, so it's perfect. Very, very, very low delta, which makes this a very safe play. So now we're gonna go to sell calls, and we're collecting $6 for that. Now we're gonna sell calls, and we're gonna sell calls for around 208, maybe 210. So 210 looks good. So let's sell the 210, and then let's buy the 212.5. Okay, $45 for about $215 worth of risk. So, or $205 worth of risk, excuse me. So this is going to be an amazing trade with a very high return. I'm just going to put 0.41, review this order. And yes, I'm going towards the low end of the bid, but that's totally fine with me because this is pretty much for educational purposes. I would not open up 10 positions and spend my time on this usually, but it's going to be a good experience for teaching you guys. So it's very fun in terms of a challenge, but it's also very beneficial for your learning. So that's why I'm opening up 10 small positions worth between 10 to 50 bucks or so. So $41 on $250 worth of collateral. That's a huge return I'm going to put on the screen right now. All right, so for the 6th trade, I'm getting a bit tired here in terms of trading, but we got to make it happen. So BABA, I do like BABA, Chinese stock. I know BABA has sold off a good amount, so the volatility is going to be higher than usual. So I'm very excited to take a look at the chart right here. And yeah, it's significantly sold off. So I'm going to be careful about the iron condor here. So I'm going to go very far out of the money for both calls and for puts because I just want to take extra measures to be safe here. And let's take a look at the options. 177 looks decent. So selling the 177, let's take a look at the delta. 6 delta, so very low, very good. And then I'm going to open up the 175. And now same thing, we're gonna sell calls. I'm gonna be a lot safer because technically Alibaba fell so much, it could have a dramatic rise upwards. So I'm gonna go for something like really high, like maybe 210, and I'm going to buy the 212.5. This is going to be closer to a 5% return. But since I'm going to lose on the bid-ask spread, it's probably going to be closer to a 4% return. So $9 on 250, about 4%, guys. So I got filled. I'm going to put the return on the screen. It's going to be about 4%. All right, 7th trade that we're going to make, or is it the 6th? I kind of lost track, but either way, all of these are going to be obviously good trades. I'm going to skip Google because Google is a very big in terms of market cap and also in terms of its price. So a little bit less premium to be made there. I keep clicking that. So we're going to do AMD as the 7th trade. Wow, we're up a lot. So I'm going to be biased on selling calls. And you know what? It's already easier to sell calls. So let's just start off by selling calls. Let me go for a $200 trade here. So I'm going to go up for a chance of profit of around, let's say 88. This looks good. I'm going to sell the 118 and then I'm going to go buy the 120, $14 for 200. That's about 7% return. Let's sell 98 just in case we get a lot of falling action. We're going to sell the 98 and we're going to buy the 96. There we go, $22 on 200. So that's again about 10% return. Click continue. I'm going to put 20 bucks. Cool. So we got it filled. So it's 20 bucks for $180 worth of capital. So that's going to be about 10.5, maybe 11% return. Next stock is Netflix. So let's do Netflix stock, NFLX. All right, guys, last 2 trades. I'm going to take a look at Facebook, and I'm also going to do Square. So Facebook and Square. FB, Facebook. Take a look at the chart. A lot of sideways action, but upward movement, which is good for selling calls aggressively. This is probably the lowest return of them all. It's about 3.8%. Square is rising a whole lot. So again, I'm going to be biased against selling call options, which is exactly what the Barclay article talks about. So perfect. I'm going to find a nearer the money option. So 295 looks good to me. That's going to be a fairly aggressive bet. Boom. Sell put. Looks like I already have a position at 250, 245. So I'm just going to do another position at
257.5. I'm gonna be a little bit more aggressive on this position. Another 18%er. Make it a 17%er. All right, so that was all 10 trades. I'm going to put how much money we collected, how much collateral we spent, and how much percent return we made for the week. All right, so I hope you guys like me securing that bag over there. If you want to see my live portfolio, more trades like this, and access to my live coaching and training where you can ask questions, apply below to see if you qualify to speak to someone on my team in the coaching application link. Thanks for watching. Give me that fist pump. No one ever sees me.